Hello everyone, my name is Anurag Gupta and I am on the quest for asymmetric opportunities for life-changing outcomes. You're watching Asymmetric Bets, an educational channel where we apply ACT framework to different stocks and companies. Now, I developed this framework after years of reading and following value investors such as Ben Graham, his Intelligent Investor, Warren Buffett and his annual letters, Charlie Munger, and other successful value investors. ACT is a very simple three-letter framework where A stands for asymmetric, C for compounders, and T for time. And over the years, I have applied ACT and gotten some very satisfactory results. I've been able to beat the S&P 500 for 3 years in a row. And today I'm going to apply ACT to Uber. But before we do, a quick disclaimer. This is not financial advice. This is for educational purposes only. Please consult your financial advisor before making any investment decisions. So let's dive deeper into Uber. So before we start to look at Uber, let's look at the framework real quick. As I said, A stands for asymmetric, and we are looking for opportunities where the downside risk is low. We can avoid permanent capital loss, and an opportunity that provides us high potential for the future. It has a long runway for wealth creation and being a multi-bagger stock for us. C stands for compounders, and what we are looking for here is we are looking for leaders with strong moats. We are looking for management teams that are shareholder friendly, that are good operators, and they don't destroy capital. They are a decent, if not a great, capital allocator. And T for time, where basically we are looking for a track record of resilience through different business cycles, as well as a long runway ahead to keep generating higher than average returns. And what we are looking for, our desired IRR, internal rate of return, is 20%. Okay, so if I look at Uber, here is a long-term chart of Uber since its IPO. And as you can see, it is down from almost $100, back in 2025 to currently at around $70. And if you look at large investors like Bill Ackman, they've come out in favor of Uber. They've made it a large position in their portfolio, right? As much as 16%. And when I look at Uber's price to earnings ratio or price to free cash flow ratio on financial media websites, I see a yield of 6 to 7%, which makes me look at Uber a little bit more closely. So we'll start with the Q1 2026 results for Uber. Here's the Q1 2026 financial results for Uber. I'm straight going to the financial summary and their operating metrics. If you look at it, their monthly average platform consumers, they continue to grow at high teens rate. In fact, it has accelerated in the latest quarter, up from 14-15% in first two quarters of 2025 to now 17 to 18%. The number of trips the consumers take, that is also growing. In fact, that is also accelerating to, from 18% to 20% in the latest quarter. Same trend on gross bookings. We see, growth accelerating from mid-teens to now, early 20s. Revenue, this is an important one. And as you can see, in terms of constant currency revenue, that has not grown as fast as the gross bookings or the trips or the user base. And this is basically an accounting adjustment where their UK business had to change the way they account the payments to the drivers. So it's actually a one-time thing. Actual revenue is higher. It showed 10% because of that accounting adjustment. Now, if you look at the most important metric in the Uber financial results, you will see operating income that has grown by 42% in the latest quarter, which is much higher than the growth rate of their gross bookings or their revenue. If you look at the two segments, mobility continues to grow. The gross bookings are up 20%. The revenue is up. Again, as I said, it's only 1% because of accounting adjustment. And operating income, this segment's operating income is up as much as 28% in the latest quarter. Same with delivery. Growth rate in early 20s in terms of gross bookings, revenue growing much faster than mobility. and the segment operating income also growing faster, much faster than revenue and gross bookings at 43%. Freight is a small business that is still struggling. So next, let's look at the Uber flywheel, the Uber network, and see the fundamentals, right? So if you look at the Uber network, there are three parts to this network. One is the consumers. They have 199 million users, and that is growing at 17% year on year. They have 10 million drivers, and that is also growing at high teens rate. They have over 1 million merchants. In terms of their key business segments, they report the results on three segments: mobility, delivery, and freight. Mobility and delivery are almost equal in terms of bookings. Mobility being higher on revenue, it's higher in terms of operating margin at 7.7%. Delivery is still smaller at 4%. But more importantly, both these segments are growing very high at a teens to a early 20s growth rates. Now, if you look at the flywheel of Uber, they have a subscription model where there are 50 million members, and that is growing at 55% year on year. In addition to that, they also have an advertising business, which is very high margin business, and the current run rate of that business is $2 billion. Let's quickly look at the unit economics of Uber. So as I said, they have gross bookings, which are 53 billion in quarter one, growing at 20% plus. Almost 25% of these gross bookings flow into their revenue, which is $13.2 billion as of Q1. Again, growing at 14% year on year, in spite of the one-time accounting adjustment to their mobility revenue. And then almost 15% of their revenue flows as EBIT, earnings before interest and income tax, right? That was almost as much as $1.9 billion in Q1, growing at 42%. And this is where the operating leverage of Uber can be seen, that in spite of gross bookings and revenue growing at a much smaller rate, the EBIT, the operating income, is growing much faster. And of course, that flows into the free cash flow. Next, we are going to look at the management and the business risks associated with Uber. So first of all, Uber is profitable since 2023. So, we don't have too much of data when Uber has been profitable. It has only been 2.5 years. One of the important things that, I found out in Uber results is their stock-based compensation expense. They have actually been able to reduce this significantly over the last 2 years. In fact, now in 2025, their overall share count actually went down by 1%. And in 2026, the first quarter of 2026, it went down by as much as 2.5%. So all in all, I think the management has been able to reduce the cost structure and rein in the stock-based compensation to make Uber profitable, as well as the delusion that was happening in the Uber stock before Dara came has been reined in to some extent, and that is really positive for Uber. Now let's talk about some of the risks. And the first one is the really important risk that the entire market is talking about, which is autonomous vehicles, robo-taxis, etc., etc. So that's one dynamic that is definitely going to impact Uber. And if you look at robo-taxis and a future where private equity or large players like Tesla and Google and others, they own the robo-taxis, they will have a much higher negotiating power than the drivers. So Uber will have a tough stakeholder to negotiate and drive the terms that they want than what they've been able to do in the past. If you look at some of the other factors that impacts Uber, it is a geographically diversified business. As much as 45% of the revenue comes from outside US. It depends significantly on the gig economy. Okay, so as we look at AI and disruption and job losses because of AI, there may be much higher gig economy workers that can increase the supply of cars and drivers on the Uber platform. So that can have a positive impact on their network. They had a lot of deferred tax benefits, some of which they have already leveraged and used in 2024 and 2025. And then lastly, they have investments in companies such as Didi, Zomato, Grab, etc., etc. There are really 4 or 5 things that I evaluated when it comes to Uber's moat. The first is the scale and network. And here, yes, they have a very large and growing user and driver base. They have Uber One, a subscription based model that has 50 million members. It operates in 70 plus countries, as well as it has AV partnership across different markets. Second is intellectual property. So one of the key things with Uber is they have data for trips, which gives them insight into what is the demand for cars at any given location at any given time. And that proprietary data helps them get the right cars to the right location and optimize. The third is execution. As I said, they have operations in 70 plus countries. They're continuously expanding their TAM by adding new categories and new service offerings. They just developed this advertising business in the last few years. So their execution has been solid with all the complexities of working and operating in as many markets as they do. And the last is ecosystem. They have an ecosystem of drivers, merchants, users, and gig economy. If I look at the future with AI, I think the gig economy is going to expand and their network will expand with it. So I think all in all, Uber has a pretty good, significant moat that it can leverage over the years in future. Next, let's look at the financials of Uber and develop a 5-year forecast. Okay, so let's start with historical financials. As we can see here, I'm looking at 2023 to 2025 and first quarter of 2026. It has grown its revenue from $37.2 billion to $52 billion in 2025 at a growth rate of 18%. And even if I analyze the first quarter of 2026, it's growing at 14%. Although this 14% is as reported, the constant currency growth is actually lower at 10% because of the dollar tailwinds as well as the accounting change in their UK business. One of the most interesting things about Uber that I find is looking at its EBIT and its contribution margin. So its EBIT has grown from $1.1 billion in 2023 to $1.9 billion in first quarter alone of 2026. That's a huge increase. And the reason for that is the high contribution margin. So if you look at the contribution margin for 2024, it was 25%. And in 2025, it was 34%. And in the latest quarter, it is as much as 42%, although it does get impacted by that accounting change in their UK business. So what I've done next is I've modeled for 5 years with 3 growth rates in consideration, 5%, 8%, and 10%. I have looked at the incremental contribution margin going from 34% this year to steadily increasing to 40% by 2030. I've assumed that they are going to dilute their shares by 1%, although they've arrested the dilution, but they are buying back shares. But there's still a significant stock-based compensation. So, in my calculations for IRR, I have not, I've not assumed that they're going to buy back the shares. I'm just assuming that they're going to dilute a little bit so that I can, take all that free cash flow and account for in the IRR. The current stock price is $70. I've also assumed an 85% conversion of EBIT to free cash flow. Again, this is an assumption. I don't know what it'll be. It's significantly impacted by the tax benefit that they are getting because of historical losses. And then the 2030 exit free cash flow yield, I've assumed it to be 4%. So if you look at scenario 1, its EBIT goes from $5.5 billion in 2025 to $11 billion in 2030. And this will translate into a free cash flow per share of $4. And if we assume the IRR calculations with $70, it gives us an IRR of 15%. Let's look at a slightly more aggressive scenario with an 8% growth rate. In this scenario, $5.5 billion of EBIT actually goes up to $14.8 billion. translating into a free cash flow per share of 5.7 by 2030. And again, a 4% yield on that, we arrive at a stock price of 141, translating into an IRR of 24%. And in our most aggressive scenario with 10% top line growth, we get an IRR of 30%. So here is the summary for all these three scenarios. If it grows at 5% top line, then we are looking at an IRR of 15%. If the top line grows at 8%, then 24, and at 10% growth rate, which is it's doing currently, then it is 30% IRR. So next we will look at what does all this mean for Uber, and if you look at it through the act lens, how does it look? In terms of asymmetric, I think Uber is priced at an interesting point. It is not very expensive. It is in line, price to sales of 2.75. Free cash flow yield looking at 2025 of 5.3, although it does get its distorted by one-time tax benefits. It has a low debt. So all in all, I think the downside is limited. It's not very high, but it certainly is there because this free cash flow yield is, significantly distorted. In terms of future potential, we can look at 15 to 24% IRR under our 5% and 8% top line growth scenarios. And the thing really going for it is very high EBIT growth, much higher than the revenue growth, and the operating margin expansion playing out. In terms of compounding, yes, it is a leader in its category, growing significantly, good return on equity, in the last few years that it has been profitable. It is buying back shares. Certainly now, when the shares are cheap, management is buying them back, so that's good. Although on the time perspective, I do have, I'll apply brakes because, it has limited track record. It has been profitable only since 2023, so we know about last 2.5 years. There could be a significant runway in the future for Uber, although the future is uncertain because of all the development around robotaxis and autonomous vehicles. So that was my analysis of Uber, looking at it through the act lens. I certainly think it's priced interesting. I'm going to look at it if it comes down around 65 or under that. Please let me know what you thought about this video. What do you think about the ACT framework? And if you want to see more such videos applying ACT framework to different stocks, then please do like and subscribe so that we can reach all the like-minded folks like you. If you have any questions or comments, please drop in the comments box below. Thank you for watching.